Hi guys, welcome to the Savvy Money Show with me, your host Sean. Today we're going through the fundamentals of stock that I look for. To do that, first we've got to find a stock. I've gone through how I find stocks. One of the two best ways I do it is stockcard.io, because you just put in your parameters, say artificial intelligence, and then you see 138 different companies, and then you can come up with different filters, but we're not going to go too hard in that. Say cdo.core, and it will give you all different information, and we'll move on to Finviz, which you can go by market cap from micro to mega, the dividend yield. You could go by volume, shares outstanding, even by insider trading. But again, this isn't about how I find them, it's the fundamentals. We're going to start with Facebook, which is traditionally known as having one of the best balance sheets, and then we're going to try with an OTC stock and compare them. Now you can see market cap versus enterprise value. We would prefer to have enterprise value above market cap. This will tell me that Facebook is traveling into the overvalued price. Forward PE, we want this for a growth stock to be below 20, ideally under 15. This is 22. Now it's a FANG stock, so it's one of the biggest growth stocks, so we understand it being a bit more overvalued at the moment, but for the moment I'm steering clear, because the enterprise value versus market cap and the forward PE. Price to sales, again at 10, which is very high. Price to book, we want this to be under 4, ideally under 3. If you can get it under 2, then that is great. In some occasions you can get under 1, but it doesn't stay under 1 for long, except for in the case of Kraft Heinz. But that's the thing. You will see down here, you'll have the float and the percentage held by institutions, which is 80%, and the percentage held by insiders. You'll have the short percentage of float. You'll have heard about GME having 140% float, 140% short. You'll have the profit margin, operating margin. I do double check these in case they are outdated, because sometimes with the smaller companies they don't update them as much as with the bigger companies. And the book value per share, along with the cash per share. Don't forget to hit that lovely like button, and don't forget the sexy subscribe button, a lot sexier than me, just ask the wife. And if you want to be a hero, hit the bell notification. You'll be notified when a new video gets uploaded. And why not check out the links in the description below. If you're looking for a free trading platform, you get a free share worth up to $200, depending on the platform you use. If you deposit a small amount, why wouldn't you? Yeah. I'll see you in the next video. Now, we look at a few things here. We look at the revenue, the cost of revenue, the profit, the expenses, and the operating income or loss. And we look to see if it's been going up, or if it's been depreciating. Now you can see it's been going up. The thing is, we need to know, there's no good the revenue going up if the cost of revenue is going up at the same amount, because then we're not making any income. We're not improving any income. The only time that is okay is when we look at the balance sheet, and again we do the same. We look at something similar. We look at the cash, we look at the current assets, we look at the total assets, and I do not like to see goodwill under assets, because it's something that they pay out, and unless it's something they keep, I do not like to see it there. But you'll see here that the total liabilities are less than the cash they have on hand and the current assets, which is good to see. And we compare it against previous years to see if they're growing, and at the same time we compare the liabilities to see if the liabilities are growing or depreciating, and we can see that yes, they were growing in 2019 because they made a lot of investments, but they were manageable still. They were still below the cash on hand, they were still below the current assets, and they are paying off, starting to pay off $1 billion of those liabilities. So they're looking to pay that off, which is good. We will look at the analysis that they have, that they think their company will do. How many analysts thought that? If it's just one analyst, well, then it's not that reliable. The more analysts, the better. And we want to see huge growth. And you see here that they think it's going to be huge growth next quarter, and then it's going to start slowing down next year. It's going to slow down towards the end of the year and then next year, but it's still going to be 19%, 25% for the year and 19% for next year. There is an argument to be made that people are not factoring in Oculus, and with Microsoft's current deal for AR technology, that would be a huge one. Now we're going to look at OTC stock to compare. Kraken Robotics, this one I spoke about, and you'll see the enterprise value is above the market cap. Again, the price to sales, price to book is a little bit shady, a bit high, but it is an OTC stock, so you would expect that. Some of the information is not in there, or is below. It is making gross profit. I'm not a fan of EBITDA, neither is Warren Buffett apparently. It has cash on the balance sheet, and it has a book value per share, which is good. Now, we can see it's bringing in revenue. The revenue has dipped a little bit, but they have been improving revenue. Revenue has dipped, you could say, the last 12 months because of COVID related, and also because they are going after a huge contract. So that is a huge expenditure during this period as well. Now, you can see again that total liabilities are covered by current assets, and you can see they've improved their current assets up to 2019. So let's get a more recent one. Now their current assets have dipped again because COVID, they had to shut down, but it's not in any bad thing, because if you look, they have paid off some liabilities and brought down their liabilities. So if their assets stay the same or depreciate, but they bring down the liabilities by even more, then that is fine. One thing I forgot to check as well was the market cap. The beta, we want it to be under 1 ideally. Is how volatile a stock is. PE ratio will show if a stock's profitable. It hasn't reported this year, so it won't be showing a PE ratio yet. The other thing we want to check is if it has dividend, the date of that and the earnings date. They reckon it will be profitable within the next year, but that's something we have to see. Now we're going to try Kraft Heinz. Now this is a company which Warren Buffett loves. Oh, sorry. And I'll show you why. I have it in my dividend ETF that I created. You'll see it, even though the PE ratio is high, you'll see it pays a stable dividend of 3.93%, and is a $49.7 billion market cap. Now the market cap, you see, against the enterprise value is 75.6 billion, so it's undervalued. People used to value it by the PE ratio, and you'll see now some people are valuing it against the enterprise value. Forward PE of 15.353, which is good, but this isn't a growth company, this is a dividend company. Now price to sales 1.9, which is very good. Price to book of 0.99, which is undervalued, and you'll see all the other information down here. You know, held by institutions, basically 80%. These companies, stable companies, a lot will be held by institutions. You know, it's basically, it's a good stable company. That's why Warren Buffett likes it. You'll see that you know, it's growing. It will have, you'll see there's not much change in there. You'll have 1 year where it dips, but more or less it stays the same. With the cash and assets, you'll see that it has enough current assets to outweigh liabilities, and enough total assets to more than double total liabilities, and it still has 3 billion cash on hand. So I hope this has helped you out. I have been asked to do a fundamentals video. This is just the basics fundamentals. I do a lot more when I'm looking into a company, but this is just the first level.